Hey TMFG community, Carlo here, and today we're talking about a number that sounds impressive when it comes to retirement, $1.5 million. A lot of Canadians think that if they hit that number, they're in the clear, that retirement is set. But here's the truth. We've looked at hundreds of retirement plans, real people with real portfolio, and we've seen just how fast that $1.5 million can shrink. In this video, we'll break down the real math. We'll show you the risks that most people ignore, and we'll help you figure out whether you're actually on track or not.
That's exactly it. Here's what we're going to cover in this video. First, we'll talk about inflation, the slow, invisible force that cuts your purchasing power in half over the course of a 30-year retirement. Then we'll walk through healthcare costs, especially in Canada where people assume it's all covered. Really, it's not. And then next, we'll dive into the sequence of returns risk, a critical but often overlooked concept that can dramatically affect how long your money lasts. We'll also look at taxes, which can quietly eat away at your retirement savings, especially if most of your money is in tax-deferred accounts like RRSPs. And finally, we'll help you answer the question, if 1.5 million might not be enough, what is enough for me? By the end, you'll understand not just what to avoid, but what to focus on as you build a retirement plan that actually works.
All right, let's dig into why $1.5 million might not be the safe number people think it is. The first issue is, you guessed it, inflation. Let's say you retire at age 65 and live until 95. That's a 30-year retirement. At just 3% inflation, which is fairly conservative when we think about long-term numbers, the value of your money gets cut in half. That means your $1.5 million only has the purchasing power of about $750,000 in today's dollars by the end of your retirement. And most people don't factor that in. They look at today's costs and assume those will hold. Second, let's talk about withdrawal rates. There's that popular rule we often talk about, the 4% rule, that says you can withdraw 4% of your portfolio each year and expect it to last 30 years. But here's the issue. That rule was created decades ago in a very different economic environment. It assumes strong market returns, low inflation, and shorter retirements.
Yeah, in today's environment with longer lifespans and more market volatility, flat 4% withdrawal might actually drain your account too fast, especially if in the first few years of retirement happen to be poor market years. Then we've got healthcare costs. Even in Canada, where we have a public system, retirees face significant out-of-pocket expenses. We're talking about dental, vision, prescription, home care, even long-term care. And according to studies, a healthy couple retiring at 65 can expect to spend over $300,000 on healthcare-related costs during their retirement. And that's assuming no major complications.
So taxes,
Yep.
inflation, market risk, healthcare, they all combine to erode that $1.5 million far faster than most people expect.
So why do so many people get this wrong? There are 4 common psychological traps that we see all the time. First is linear thinking. People assume that markets will deliver steady 6 to 7% returns every single year. But markets don't work like that. They move in cycles, and the timing of those returns really matter, especially in retirement. We'll talk more about the sequence of returns risk in a moment, but for now, just remember, flat projections rarely reflect real life.
Secondly, it's recency bias. If inflation has been low for a while or markets have been very strong, people assume that will just continue. But history tells a different story. We've had decades with inflation well above 5% and bear markets that have lasted years.
Yeah. And third, people underestimate healthcare costs. Because we live in Canada, there's a tendency to believe the system will cover most of our retirement health needs, but in reality it won't. Long-term care, in-home support, specialized drugs, those aren't always covered. And if you or your partner face cognitive decline or mobility issues, those costs can really spike.
And fourthly, longevity.
Yeah.
Most people plan to age 85, but many of us are living well into our 90s. That's a 30 or even 35-year retirement. This means your money needs to last not for 20 years, but possibly twice that.
Yeah, and put that all together and you can see why 1.5 million, while a great milestone, may not provide the security it may appear to.
Okay, let's take a look at the real math behind that $1.5 million. Okay, you're going to retire at age 65. You're withdrawing 4% per year. That gives you $60,000 annually before tax. After tax, it's probably closer to $48,000, $50,000 a year, or $4,000, just over $4,000 a month, depending on your province and your income mix. Now consider CPP and old age security might add another $20,000 to $30,000 combined. In total, maybe you have between $70,000 to $80,000 per year to live on.
Yeah, which sounds good. But here's the catch. If your cost of living is $75,000 today, In 20 years, that same lifestyle could cost you $120,000 plus annually due to inflation. Now let's subtract healthcare. If you and your spouse spend $300,000 over retirement, that's 20% of your portfolio expected to be gone to healthcare.
Yeah, and what if you hit a bad market early in retirement? Let's say the first 3 years sees a combined minus 10% average return. Your portfolio may never fully recover. That's the sequence of returns, risk, and action. You're withdrawing money while the market is down, which accelerates depletion. All of these forces work together, compounding the pressure on your savings.
So what can you do to protect yourself? The good news is there are strategies that help stretch your retirement income and reduce risk. First, think of dynamic withdrawals. So instead of taking a fixed amount each year, you adjust based on market performance. In good years, you take a little bit more. In down years, you tighten up the belts and take a little bit less. That flexibility can dramatically extend your portfolio's life.
Second, tax optimization. The order you withdraw from your accounts matters. Do you withdraw from your RRSPs before TFSAs or vice versa? These are questions that we get asked all the time. And coordinating withdrawals with your spouse, how does that go? All of that can reduce your tax bill significantly over time.
Yeah. And the next option would be a partial retirement. Many people find that working part-time or even consulting for a few years after 65, even just 10 to 15 hours a week, can give their portfolio a big break. And it helps them transition to retirement a little bit more gradually.
Fourthly, guaranteed income strategy. Now that could include annuities or insurance products that protect against longevity risk. Or you could be allocating a portion of your portfolio to assets that generate consistent cash flow.
Yeah. And finally, plan for flexibility. Your expenses are going to change. Your needs will change. Your portfolio needs to adapt as you go.
Now you might be wondering if $1.5 million isn't enough. What's the right number for me? And the honest answer is, it depends. It depends on your spending. It depends on how long you live. It depends on your taxes, your investments, your healthcare needs, and your desired lifestyle.
That's why we don't give these magic numbers. We're going to build custom retirement income plans that are going to factor in all these risks and provide you a roadmap tailored to your situation.
What's a good retirement plan look like? Well, it needs inflation protection. You need tax-smart withdrawal strategy. You need contingency plans for healthcare or long-term care. And you need the ability to adjust over time. If you don't have that yet, now is the time to start.
Yeah. So is 1.5 million enough? For some, it might be, but for many Canadians, it's not. The real key is understanding your specific needs and building a plan that's flexible, efficient, and resilient.
So if you want help creating that plan, click the link in the description. We'll walk you through your situation and help you design a retirement income strategy that works for you. Thanks for watching, and we'll see you in the next video.